Good afternoon. Thank you, everybody, for joining us. My name is Michael Del Castillo, senior editor at Forbes, where I help oversee our blockchain, cryptocurrency, and other financial infrastructure coverage. Here with Ronan Ryan, one of the co-founders of IEX, who many people have got to know through Michael Lewis's 2014 book, Flash Boys. As I like to think, Ronan was one of the first people that helped make my job easier by making financial infrastructure cool. I think you guys might have been one of the first people to actually successfully do that. Ronan, thank you again for joining us.
You're very welcome.
I want to go back in time.
Yep.
We like to kind of spend some time getting to know our guests a little more personally before we get to some of the news of day and the business that kind of like brings them up to the surface. So you have a little bit of an accent here I'm picking up.
Yeah.
Where were you born? And tell me a little bit about mom and dad. Like, what kind of parents did you have growing up?
Yeah, I was born in Dublin, Ireland. If I had 3 pints, I sound a lot stronger than I do currently right now. I moved to America when I was 16 for junior year of high school. So I've been here quite some time. I think I turned 48 this year, so I've lived in America 32 years and Ireland 16. So two for one. But my parents and all my family live there. I have one sibling here. My brother lives in America. But besides that, I don't even have a second cousin, which is kind of astronomical considering I think I have 51 first cousins. But most everybody is in Ireland.
And what were mom and dad like? What did they do for a living? And sort of like what did they kind of bring to the table that maybe helped build you into the co-founder of an exchange?
Yeah, well, I don't even know how the hell I got here, but I'll tell you. So my dad worked for a division of the Irish government, and the role of that division was to get international companies to set up in Ireland. So with the forming of the EU and before it the EEC. A lot of American companies wanted to be in Europe, and there's tax breaks, and there's a whole kind of reason. So Ireland, a lot of people didn't realize it because back in the 80s, it was a relatively poor country. It was like tourism and agriculture were the number one industries.
And literature.
Yeah, and literature, of course. That's why.
Unfortunately, there's not a lot of money in literature.
Yeah, there's certainly not. But gift of the gab. But anyway, the group, the Industrial Development Authority of Ireland, looked to sell Ireland. So my dad was basically a salesman for Ireland, and he was so often in America bringing so he brought companies like Apple and Intel and real brand name companies to set up their European operations in Ireland. And something like 68% of our population was underneath the age of 23, and seemingly the educational system, which I thought was horrendously hard compared to when I moved to America, is apparently very good. And many companies had success setting up in Ireland. So that's what he did for a number of years. So in answer to your question, he was an incredibly hard worker. He was a good role model for me. He was the son of a bus driver. My mom, the son of a plumber. So I learned just hard work and just
awesome.
Don't be too
I can
impressed
see
with
some
yourself.
synergies between what you must have seen during that time and what you do today.
Yeah.
Very briefly, what about mom?
So my mom was I guess you'd say a stay at home mom.
Great,
but she's been great. She's sort of someone who's still at 48 years of age. I had like a little cough last week, and she's checking in on me every day. I'm like, Mom, I'm fine. I'm fine. It's not COVID. It's just a cough. But it's kind of funny. And now I have a daughter in college, and as she's left the house, and my son's a junior in high school, about to leave the house next year, I'm already getting those inklings of checking in on them. So
I love it.
I guess chip off the old block from both of them.
When you think back to growing up,
yep,
and you think those influences, maybe other influences, teachers, friends, I'm not sure. What's the first sort of concrete story? The first anecdote that sort of jumps out where you're like, that little kid is going to grow up to found IEX.
I don't know if it ever jumped out that I would come and found a stock exchange, but it was just, I don't know. It was just from an early age, I think I hustled, right? Like I used to deliver leaflets. There weren't newspapers in Ireland. Just was always looking to find a way to make some money and to do something interesting. So I don't know that there's any thing that lightning strike says you will be on Wall Street, Sonny.
Hustling counts.
Yeah.
I mean, hustling counts.
Yeah, it's true.
That's actually a very common first story there. So then let's skip ahead. I love learning about your parents there and a little bit about the hustler kid. What were you doing right before the founding of IEX? Sort of where were you positioned that led you to see something
Yeah.
that made you think, oh my gosh, I have to found this?
Yeah, and I'll back up slightly before that,
Please,
because it'll make a little bit of sense. Like, I mean, the book Flash Boys was written 9 years ago, so I'm not telling people go out and read the book to learn about Ronan. I'm not that arrogant. But what I would say is, when I left college, my first job, I actually learned telecom network engineering. I wasn't on Wall Street at all. I wanted to work on Wall Street, didn't work out as planned in college. And the reason why I give that background is we founded IEX in 2012. But in 2009, I was hired by the Royal Bank of Canada in electronic trading. And people would like, I think my dad thought I was climbing telephone poles or something. He's like, what the hell do you know about trading? I'm like, one, thanks for the support. Two, I was on the networking side of it. But at that time, people will probably forget, but like 2007 to 2009, trading and technology smacked into each other.
Yes.
You start hearing about things like high speed and all this stuff. And what does that mean? Well, in order to trade high speed and to do things electronically, you kind of need technicians. And in any case, I was hired by RBC, and Brad was my boss. Brad's the CEO of IEX.
Brad
Katsuyama.
The CEO of
of IEX. So
and your co-founder.
So continues to be my boss, but co-founder, we like to say,
All
partner
right.
in crime. But in any case, he had hired me because he was a trader. He would go out and explain to clients, about the new algorithms, electronic trading, and he wanted someone who sort of knew the undercurrent, like the underlying technology and how it works and why speed matters, etc. And that was kind of my original role. So in answer to your question, we did that for a few years. In RBC, we developed a software known on the street now as Thor. Everything has to be an acronym on Wall Street.
I love how much you hate acronyms, by the way.
Yeah, it just cracks me up because Thor sounds like cool, but it stands for Tactical Hybrid Order Router. Everything is like this. But it was great. We took the industry by storm. And we were helping clients.
Let's pause though really quick. So you're working with Brad at the Royal Bank of Canada.
Yep.
And you get this assignment, and that assignment sort of leads to a discovery. And I don't know if an epiphany is too strong a word. What did you find through the course of that research that led you to identify the IX opportunity, and how did you go about solving that?
Yeah, so I guess the epiphany, if you will, I think our CTO now, Rob Park, came up with it in the shower. That's as deep into that moment as I'll go. But
no follow-up questions.
Yeah, but not to get too wonky. Basically, what it was is back in the day, people are trying to trade, then everything went electronic. And then when people would try to buy stock or sell stock that they saw on the screen, the stock would move away from them. And people just thought it was a matter of them being too slow and pressing the button. And we developed software where we sort of figured out where all the liquidity was, and we set up a way for people to access it. And by doing so, it was like almost overnight change. And all the institutional investors loved it. And where IEX came from is they said, well, the problem is we only can avail of this technology when we trade through RBC, Royal Bank of Canada. We have to trade through all these other brokers for various reasons, relationships, IPO access, research. We can't send every share to RBC. If you can think of something big, we'll support you. This literally happened.
Yeah.
So we're like, well, how do we solve the problem for institutional investors when they trade with every broker? And if you really look at the center of the ecosystem, it's the stock exchanges. Every broker is required by regulation to connect to exchanges. So we're like, okay, if we can put ourselves in an exchange and then take the order from the broker there, what can we do to make the execution quality better? And that was really the idea. And I will tell you, the four of us, it was 8 day one, but the four of us who quit our jobs to do this, I still laugh because my wife would go, how the hell did you guys build a stock exchange? And still, 13 years later, 11 years later, sorry, I don't really know. None of us had ever really worked at one, but it was just a lot of hard work and Googling and just like...
Well, like I said, I do think that you guys back then, I think, had a lot of sort of chemistry and a lot of the traits that I'm seeing a lot in cryptocurrency and blockchain developers today. I said it joking, but there's a little truth to it. Like if I'm at a party, people ask me what I want to do, and I want to see their eyes gloss over. I say I write about financial infrastructure.
Yeah,
because people just didn't care about it, and they really don't in a lot of ways.
Yes,
but as soon as you call it blockchain or crypto, like they pay attention.
Yeah.
All of a sudden now people care about financial infrastructure. And I think that IEX in a lot of ways was one of the progenitors to making that happen.
Yeah.
What is IEX? Let's do a quick top down.
Okay.
Where are you based? How big are you? And what on earth is it?
Yeah. So IEX in 2023, we're a registered stock exchange. So Probably most of your listeners will know of the New York Stock Exchange, and many will know NASDAQ. There's actually 16 stock exchanges in the U.S. now. Names like Chicago, Boston, New York, Philadelphia. All 16 are in New Jersey, and all 16 of them are in 4 buildings in New Jersey, because everything trades electronically now, which means computers place themselves right next to the exchange. So in order to do so, you need to be in a data center. So when you see on TV, on CNBC, in the floor of the New York Stock Exchange, those guys going around in jackets, they're not trading there anymore. It's all done electronically. So IEX stands for Investors Exchange. Since 2016, we've been a full stock exchange. We launched in 2012, and we were something called an ATS, or also dark pool, bad marketing, but that wasn't our name for it. We were a mini exchange from day one. And then we filed to become a stock exchange in 2016. We launched as a stock exchange.
And tell us a little bit about the companies that choose to list at IEX. Like, are there any trends, like the 2 or 3 verticals that are most popular? And tell us a little bit about the volume, the size, that sort of thing.
Absolutely. So we don't do listing services. So the only real exchanges where people list right now are the New York Stock Exchange and NASDAQ. There are ETFs that are listed on other venues. But for the most part, the way the regulation works is if you run a stock exchange, you can trade any symbol, any stock. You don't have to have that stock list on you. So it used to be if you were IBM and you listed on the New York Stock Exchange, you only traded on the New York Stock Exchange. That's not that's not what happens anymore. So we actually don't have to have listings. So we trade basically every single symbol at one time or other. I'm not going to say we trade every single stock every single day, but right now we do roughly like 500 million shares a day. And that puts us, that sounds really nice and big, but that puts us at about 2.5% to 3% of U.S. equity volume, which just goes to show you how big the U.S. market is.
But I think notably, in the time that you guys have launched, the former juggernaut in the room, New York Stock Exchange, has dropped market share from something like 78% down to like 13 or 14%.
Yeah, they're down sub 10 now. Yeah. Like the biggest individual stock exchange is NASDAQ. Depending on the day, about 14 to 16% now. So it's fragmented out across many venues, like I said.
So I think that a lot of our audience is going to maybe see some comparisons between what has happened in the exchange industry in the old days, and by old days I mean like 20 years ago, when there was basically one major exchange doing 70, 80% of all the trading. And today, like, we talk about sort of making unnecessary middlemen less necessary or unnecessary. You know, we talk about competing with the Facebooks of the world, the Googles of the world. Like back then, that was competing with the New York Stock Exchange.
Correct. Yeah.
As you look back at the years that have elapsed since you launched, and sort of like the lessons learned with building a company to compete against something like the New York Stock Exchange and its hegemonic glory, like what lessons can we sort of like take away today for companies that are looking to compete with the new big players in town?
Yeah, that's a fantastic question, because as you were asking it, I was like thinking, what's my answer here? But like that parallel to like crypto and taking on the big guys, it's massive. And all I can say, and like I mean it honestly, it's like you got to have grit, and I'll tell you why. Because the large incumbents, they fight for what they had, and they're just it's a ferocious battle. Like every time, like it's pretty interesting, because I always say to my wife, like, it's a funny industry in that like there's David and Goliath. I like to think of us as David, and the Goliath is the big industry. But it's easier sometimes for people to side with Goliath. You know why? Because he's probably going to win, right? And people don't want to bet on the little guy who gets beaten up, I guess, maybe. But every time we file to do new order types, even file to become a stock exchange, we're famous because we slow things down. We have a speed bump.
Yes.
We slow things down 350 millionths of a second, 1/1000th the blink of an eye. Whoever measures this shit, I swear, it's like next to nothing. But there's a really important reason why we do. And we do it to protect investors. And our competitors didn't like it. So in answer to your question, you know, when you wade into the pool where people are already there, and they have their own stake, they're going to fight really, really hard. And I think all you have to do is you have to have grit. You have to have a business case as to what you're doing, why you're doing it, and how it helps people. And we look, and I don't mean it in an arrogant way, but we have been up against the biggest firms in the industry have written against IEX. So it's public record. They've sued the SEC. They've sued us. NASDAQ have sued us. Every single one of them, in the end, the smaller group, we have prevailed. Are we the biggest stock exchange in the US right now? No, but we're far from done. So it's just a matter of, and like what I would say to anybody starting up in the, the crypto space, digital asset space, Web3, there's so many names. It's almost more acronyms than on Wall Street now soon. And you know how I don't like acronyms.
Oh, yeah. A good, strong journalist instinct in you that I respect.
Simplify,
yes.
Anglify.
Yeah.
No.
So I do want to talk about not the lawsuits specifically, but some of like the regulatory climate that we're in today, as some of the incumbents are battling to keep territory, as some disruptors are looking to maybe redefine some of the way that finance works. As we sort of set the stage for that, I want to talk a little bit about one or two of sort of like the most recent technological innovations that have led to the climate that we're in today, where we might end up needing some new regulation. We'll get to the regulation itself in a second. But before, like, when you look at all of the financial technology out there, you mentioned your own speed bump. You know, we mentioned blockchain and crypto. Like, there's countless other innovations out there. Are there one or two that jump out to you as kind of like the most important for defining our current time?
Yeah, absolutely. So I'll back it up slightly just to tell you the current regulation that Wall Street trades under for stock right now is something called Reg NMS, stands for National Market System. It was proposed in 2005 and implemented in 2007. So this was a while ago. So think about what's happened there. Like I was telling you how trading and technology smacked into each other.
Yeah.
There was still a floor where there were people, humans trading when this regulation went into play. So big things that have happened. It's not just speed. Things got faster. Like I said, all 16 exchanges are in New Jersey. They were not in New Jersey. They used to be in Chicago, Boston, Philadelphia, New York City, believe it or not, is where the New York Stock Exchange was. Now they're all in New Jersey because speed. The speed of things and the electronification of the market has it's gone parabolic, and it continues to get faster and faster and faster. And it's very hard to survive. Well, not survive is the wrong word, but it's very hard to say that regulations that went into play before you could even predict what was coming from a technological standpoint. Like the iPhone wasn't even invented back then, if you think about it, because I have my kids grew up just swiping and they know everything to do. But just to give you some perspective there. So the speed of trading, and like I was saying, co-location means now being close to something, you literally have to have your computers in the exchange's data center. And literally people get into arguments over within the building how close they are to the exchange's software. So much so, and there's a reason why I tell you this, but so much so, people said, okay, let's make it fair, and we'll give everybody in the building the same length of cable to connect to our venue. So IEX said, yeah, that seems to make sense. So when we launched our data center, the only difference is we wanted to slow things down. We gave everybody a 38-mile cable. It's called a speed bump. We just delay everybody coming into our platform. We literally have, I'm not making this up, we have 38 miles of fiber optic cable coiled in a box, and everybody comes through there.
It's counterintuitive. Yes. Really quickly, I don't want to take it for granted. Like, why is slowing something down considered a service to your traders?
Yeah, so I tell you why. So it's slowed down for everybody. So everybody accesses IEX the exact same way. We don't provide any backdoor. The reason why, so people call it a speed bump, but sometimes I like to frame it a little bit differently. It's a head start. It's a head start for the exchange. When you're a stock exchange, which IEX is, your job is to provide the best price to your client. And the only way you know what the best price in the market is, you take in all the data from all the other exchanges and you go, oh, the best bid in the market is 10, the best offer is 12. So now you know 10, 12. Well, things are changing so quickly that the fastest of the fastest can see all those changes and trade on exchanges before the exchange even knows the price has changed. So by us slowing everybody down, this is the real crux of it, it gives us a head start to digest all the market data out there in the market so that when we consummate a trade, we do it at the most perfect price. We tried to call it true price, but apparently you can't trademark true price. But in essence, we try to achieve the most accurate price there is out there. And the crux of it is this, is no one is faster on IEX than IEX is. We're not trading our own money. We're doing this for the buyer and the seller of the order, no matter who they are. And I always say this, look, if someone buys stock and the stock goes up or the stock goes down the next day, that's not my job.
Yeah.
My job is to referee at the time that they're trading at the fairest price available in the market. And that's why the speed bump is key.
So I'm glad you mentioned the fact that those regulations were out 2 years before the iPhone.
Yes.
You recently co-authored a report that sort of like helped set a stage similarly, that it was a whole list of surprising things that hadn't happened yet, including that.
Yeah.
Give us, first of all, as closely as you can remember, what was the exact name of that report? But let's also talk about a quick little summary. Like what was in that report? What are you guys trying to define here?
Was this the comment letter we submitted to the SEC recently, or which report?
The report on the IEX blog about the national market.
Oh, yeah. So I so the spirit behind that, let me tell you, is if you happen to be so lucky to be involved in the financial press and you're reading all of this nonsense over the past few months, the SEC came out with new proposals in December of last year, and March 31st, which was just this past Friday, they had asked people to submit their comments in response to those proposals. And the reason why we put out the report is what happened is a lot of people started screaming bloody murder and saying, these proposals are crazy, too much complexity. Everybody loves to use this term, unintended consequences. And we wanted to call out, hey, I'm not saying that these proposals are perfect, but there's 4 proposals, each have quite a bit of detail in them. But there's nuggets, there's gems, whatever you want to call it, contained within there. So you can't just broad stroke say, everybody's against the SEC and Gary Gensler, because that has been the narrative in the press. So the blog we put out was just to sort of draw attention to hey, here are a few things you might want to look at. Here are things that are good for investors. And actually, we've seen if people have submitted their comment letters, their public comment letters, if you actually read those, what people put on the public record in writing to their regulator, read those. Those are more intellectually honest than some of the nonsense people have said, and has been reported for the past few months. So I think if people start to see the forest through the trees, again, Ronan from IEX is not saying all these proposals are perfect.
Yeah.
But there's some really, really important gems in there. And to say you shouldn't change the market, and we've just talked about how much it's changed since the original proposals in 2005. It's almost 20 years.
Yeah.
Come on, people.
Yeah. So there are 4 main aspects of these proposals.
Yep.
And you're the podcast that you co-host, Boxes and Lines.
Correct. Yes.
Boxes and Lines does a really good job getting into the weeds on that.
Yeah. Yeah.
So I don't want to kind of rehash a play-by-play of all that. Plus, I think John was kind of the expert on that one, right? Let's when you look at the 4 proposals collectively.
Yep.
Are there 1 or 2 things that you think people who are paying attention are getting wrong or misunderstanding?
Yeah. So I think the main thing people are misunderstanding is they're bucketing all 4 together. So I won't go into the wonkiness of it. You're right. We do go into it on our podcast. John Ramsey, my co-host, was former head of trading and markets at the SEC. Former lawyer.
Which he likes to drop in every episode, right?
Yeah. He's a lawyer. That's what they do. Billable hours, billable minutes on a podcast. Not that we get paid for this shit, but in any case, I think my disappointment in all of this is that people have just bucketed all of these together. And I was telling you, I sent out a blast to our clients a few weeks ago, and you always want to grab people an email blast with a subject, and I wrote it, "Listen all y'all, it's a sabotage," from the Beastie Boys. Epic song. But my point was, hey, if you read all the narrative that these proposals are crazy and Gensler's off his mind, well then you're not getting the true story, right? And if you're intellectually honest and you actually look through these proposals, there's some nuggets in there that are very, very important and very helpful to the institutional investor. And people have been complaining publicly about things for a number of years. And some of those things, specific things, are addressed within the proposal. But people just want to go, unintended consequences, everything's great, the market's never been better. The market's great, but it can always be better.
Well put.
Always be better.
So what's the one thing that you would sort of like elevate above, the biggest opportunity to improve?
Yeah, the biggest opportunity to improve, I think, and the reason why I elevate this one also is it is extraordinarily simple for people to implement. Because then people talk about complexity. Extraordinarily simple. It's a pricing change. So when the SEC came up with Reg NMS in 2005, like I said, one of the things that they did, and it was along the lines of your question actually on listing on exchanges, they said this. They said, all stock exchanges now have protected quotes, which means if a stock exchange is quoting a stock, before you go and trade at a worse price, you have to trade on that exchange. So to a certain extent, it gave exchanges a mini monopoly. But what the SEC came in and said is, we're going to do an access fee cap, which means you can only charge 30 cents per 100 shares traded. That's the max fee you can charge, right? Now, if you fast forward to almost 20 years later, I know as nutty as this sounds, but there's billions of shares trading. 30 cents is a very, very high number. It's a very high number. And
it's a very high number because of the frequency of
the
trades.
Frequency. Yes.
So if you're doing 1,000 trades a day or 1,000,000 trades a day and you're paying 30 cents, so that's why it's actually more than it sounds like.
It's billions. It's billions. And if you think about it, over time, technology becomes cheaper. So what happens? The commission rate that brokers are paid from the street is less, but yet they're still stuck paying the exchange fee. I work at an exchange. You would imagine I wouldn't be advocating for this. But also the reason why we are is because on exchange volume right now, 86% of the time, one side of the trade is paying the exact maximum fee. Like it's been pinned to the max 20 years later, 17 years. Yeah.
So that's interesting. It wasn't actually just a max. It wasn't the required price, but of course it's a capitalist system. So it always goes to the max.
It's funny how that happens. And the 30 cents per 100 shares, it wasn't like quantitatively derived. At the time, the highest fee an exchange was charging was 30 cents per 100 shares. And the SEC said, all right, fellas, let's stop it there. And now we're saying 17 years later, that doesn't make sense. And there's a lot of wonkiness behind it that I won't get into. But if people are interested, read some of these comments. But there's real reasons why lowering that can have a massive impact to the brokers, to the buy-side institutions. And guess what? I run a stock exchange.
Now,
you can make money.
You're at a little bit of a disadvantage because I did just listen to some of your podcasts, and I know that you're pretty good at explaining this stuff for normal people. So I'm going to push a little harder there.
Yep.
Can you pull out just one example of some of that wonkiness?
Yep.
And how maybe we can use that to transition into what the proposal is.
Okay. Yeah. So I'm happy to. So think about this. If the way in which it works on Wall Street and trading on exchanges, there's something called a maker-taker model, meaning this. If an exchange can charge you 30 cents per 100 shares to trade, they also rebate the other side of the trade, right? So one side of the trade pays 30 cents per 100. One side of the trade might get rebated 29.5 pennies, right? So now just think about that. It sounds interesting. Okay, one side pays, one side doesn't. Now, let's say you're a broker and your commission rate has been jacked down very low over time because that's where prices go. And all of a sudden, if you trade on an exchange, if you take liquidity, you're paying 30 cents. If you make liquidity, provide liquidity, you get 29.5 cents back. Now, does that present itself a perverse incentive? I'm not saying, just saying. In a lot of cases, and the reason why there's a ton of data to watch this. So exchanges, like I was saying, they change pricing all the time. Just today is, the first trading day of the month. So our product guys send us out every single month, exchanges change their pricing and people react to that pricing. The exchanges that pay more rebates all of a sudden get more market share. And IEX is the only exchange that has never paid a rebate. We don't agree with rebates. So long story short is if you lower the fee, the most you can charge, that means you can't, unless you lose money on every trade as an exchange, you're not going to rebate more. So if you lower that fee, there's less of a rebate. There's less of an incentive to maybe route where you shouldn't route at a time that you shouldn't route on behalf of your client.
And I think it's intuitive who's benefiting most from the current system here, but I don't want to make any assumptions there. Who are the counterparties that benefit most from the current 30-cent fee?
Yeah, so for the most part, they call themselves market makers. And I don't villainize high-frequency trading or high-speed trading. Sometimes people took from the Flash Boys book that they're the villains of the market. They provide a real service in the market, and everybody's fast, by the way. Every broker representing institutional investors is a high-speed trading firm at this point. The difference between that and brokers is high-speed trading firms, they trade their own money.
Yeah.
So if they're getting a rebate, they're getting a rebate. There's no perverse incentive. They want to make money, they can get a rebate. It's totally fine. But what happens is, most of the time, people trading on behalf of institutional investors have to come in and access liquidity. They have to take stock. They get an order, buy me 10,000 shares of ABC. They can't sit on that order till the next day. They have to go get it. So most of the time, the institutional brokers are paying the fee, the market makers are receiving the rebate, and it impacts the institutional investor. So it's good to be the fastest. It's good to be a market maker. And a lot of those guys and the wholesalers are the ones, they don't protest too much or the most about these SEC proposals because, again, I'm not saying there's anything wrong with what they do, but they're having a pretty good time.
So let me flip that on its head. Who loses the most?
Who loses the most if all these proposals were to go
in the current system with the 30-cent fee? Who's getting taken advantage of with that?
Yeah, it's an interesting way to phrase it. What I would say is if you leave the fee where it is, in the end, it's going to harm the institutional brokers because the commission rates have come down lower. They have to be as fast as they can be, so they're spending money on technology, and they're still paying these high fees to the exchange. So the beneficiary or the receivers of the rebates and the people who are harmed, I guess you would say, are those who have to pay the 30 mils, the 30 cents per 100 shares. Like I said, 86% of all volume, one side of the trade is paying the full amount.
So what's the regulatory proposal to fix this? And why is it wrong? I'm just kidding.
Yeah.
What's the regulatory proposal very briefly? And what are your thoughts on whether or not it's good, it's bad, it needs to be changed?
Well, the specific one on this is they said it's called the access fee cap of 30. Mm-hmm. They said we propose to lower it to 10.
Okay.
There's scales and there's wonkiness to it, but basically it's proposed to move to 10. I think what you'll see though is a lot of the public comments that have come back, and this is kind of why I wanted to tell you broad strokes the wrong way to look at it. Tons of people, pensions, institutional investors, household names are coming back and saying 10 mils is 10 cents per 100.
Yep.
We call it 10 mils. It's tenth of a penny. Acronym.
I love it. Explaining the jargon. I appreciate it.
But there's a lot of support for that, by the way.
Yeah.
But if you read, what you see in the press, you would just think everybody thinks Gensler's nuts. So there's that. There's a few other nuanced things like that. The thing that the shiny ball that everybody's jumping at is one of the 4 proposals is saying all retail orders should come to an exchange auction mechanism, and it is very complex.
Mm-hmm.
I'm not saying it's totally wrong. We don't have all the data, so for IEX to sit there as an exchange and go, this is the right way to do everything, we didn't particularly comment on that one. But the system that exists today for retail orders, like if you're a retail trader and you buy 100 shares or 100 shares of Apple would be a lot of money, 5 shares of Apple, and you trade for free, do you have it good? You've pretty good. Could it possibly be better? And that's what the SEC are proposing. I think what they're proposing would take a lot of work for the industry and also assumes that what they have in place today, not even saying that it's the best, they're almost insinuating that it's not good.
And
that's where a lot of the cannons are pointed, as opposed to the other 3 proposals. Like one of the proposals is everybody's like 605. It's a proposal saying you should disclose more information post-trade. Everybody's, that's fine. That can go through.
Yeah.
So it's really only 3 that are getting any attention, and it's the retail auction that is getting, the ire of the street. Yeah.
I want to talk a little bit about some of the claims I've read out there that SEC Chair Gary Gensler is being a little opportunistic with some of these proposals here. I've seen some folks tracing back the impetus for these changes to the so-called meme stock trading phenomenon over the last couple of years. Do you think it's fair to say that the meme stock phenomenon is behind the desire to upgrade these regulations, or is that a little too on the nose?
No. It's some of the proposals. So like the retail auction, it's very fair to say that happened under Gensler's watch. It's not that anything that he did before getting there. He had just gotten into his office. Was his fault. It was
Regulators don't often deserve sympathy, but in that one, he might deserve a little sympathy.
That one was bad timing. Look, COVID. There was all kinds of things.
So to be clear, for people that don't know, Gensler comes on board, and immediately something happens with what we now call meme stocks. Can you give like a 15-second sort of overview of this concept?
Yeah. So meme stock, what it really became is this, and factually, this happened when everybody went home for COVID in like March of 2020. Home for COVID sounds like going home for lunch. When people were kind of stuck in their houses, like factually, more people started betting on sports and betting on Wall Street. And a lot of people were taking their checks from the government and opening up Robinhood accounts, which is a retail trading account, and they were trading stocks. And then at the same time, people got together on Reddit. Now, I'm 48, so I'll date myself. I didn't even know what the hell Reddit was. But there's all these channels, and they would just start talking about stocks, and they started rallying behind stocks. And a couple of stocks that they rallied behind were GameStop.
Yep.
A lot of these guys were former gamers. Everybody knows this. I'm
old gaming company that was not doing well,
a brick and
whose
mortar
stock
shop
was slowly going down.
I have a son who was 15 at the time. We have not bought a physical game for his Xbox because it's all downloaded. So brick and mortar store, not doing too well.
So the market had kind of decided that GameStop stock should go down.
Yes.
And maybe rightfully so. Brick and mortar was dying.
I think
video
rightfully
games
so.
were changing.
Yes.
And then what happened to sort of like change that dynamic?
So what happened was sort of like sticking it to the man. So on Wall Street, you can short a stock, which means you bet that the stock's going to go down. You think that GameStop is a bad company, and you think they're handling things wrong, and you think their stock's going to go down, you can bet that they're going to go down. And that's the hedge funds. And those are more the bad guys at Wall Street from the retail perspective. So the retail got together on all these Reddit channels and decided to buy and buy and buy. And it's like anything, the more you buy, the price goes up. And they jacked up the price of GameStop. It went up hundreds. And some of these hedge funds went out of business. They lost billions of dollars
because they had bet against it.
They had
shorted it, and this market activity going up, driven by retail investors with extra money and extra time, cost these institutions
lots of money,
hundreds, millions, billions of dollars.
Billions. Like if you buy stock for $10 and the stock goes down to zero, you lose $10.
So let's try and take that very clearly explained problem and tie it back to one or two or all, I don't know, of these regulations. How might the changes in these regulations sort of like help prevent that from happening in the future?
Well, I don't know that it could prevent the meme stock from happening, because that was sort of like almost a social revolution, if you think about it, right? There was COVID, people at home, time in their hands, rallying behind each other. Like some of these people got called into like the House Financial Services Committee because they're like, are you pumping up this stock so you can dump it? It almost was like a pump and dump thing. But to your question, a light was shone on retail trading and how it's handled.
Yeah.
And the way in which retail trading happens today, a lot of people don't know. You use your app and you get an execution back. Very, very, very little of that ever finds its way to a stock exchange. Usually those orders are handled by someone called a wholesaler. A wholesaler agrees to trade against your order flow. And of course, they're making money on it. And I'm not saying they're bad guys. They're making money on it, but they are also, pumping the Bible saying they give the best execution you could possibly receive. And Gensler's just saying, well, maybe there's another way. Maybe there's a better way. Maybe there's an alternative. Maybe it doesn't all have to be done by wholesalers. Except a little bit of this got like public tit for tat. And I don't know the psyche of Gensler per se, but there's been a lot of public attacks on him, and he's attacked back. And he's clearly taken a line where he believes that this wholesaler payment for order flow arrangement is bad, and he believes he's provided data in his proposal that trading retail on exchange could be better for retail investors. And that's one of his main, of the four proposals, that's the one that everybody's got their cannons pointed at, because it's a very, very big business, and it's complicated to change it.
So as we wrap up, a quick follow-up here, and then I want to close a little bit about some of your work with Pith and some of the other crypto stuff. Yeah. So a skeptic could say that the retail traders were just doing the same stuff that institutions and licensed investors do all the time. And the only difference is that these are, it would be really skeptical. These are poor people doing it, and we don't want the poor people doing it. And I think it's a very, I'm being intentionally a little obtuse there, but there is an argument, I think, to be made that the behavior that they were doing, that these folks on Reddit, these retail traders, were doing was just what big institutions do all the time. And the reason why regulators are reacting is because it was bad for the institutions.
Correct.
Is that an overly obtuse way to look at this? Is this regulation essentially set up to help institutions and harm retail investors? Or is it really, as Gensler is advocating, going to be better for retail investors to see those trades being forced to go through as an exchange?
The irony in all of this is the retail community are profoundly supporting Gensler and doing this.
Interesting.
And the people who are against it are the big wholesalers like Citadel and Virtu. So I would never call, no offense to these guys, that these are the poor guys.
Yeah,
right?
that's true.
So the poor guys are supporting the regulation.
Fascinating.
What I would say, though, slightly, that's one
Please
answer
correct
to your
me.
question.
Yeah.
But yeah, like it's funny. It's the exact inverse. But the proposed change is pretty dramatic, and there are a lot of unknowns in it. So I would say people asking the question, if someone's actually not talking their book and honestly asking the question, which I think I am, there's nothing for me to gain on this. I think there needs to be a much more analysis done on what was exactly proposed, if that is actually the answer, right? The tone of it, the idea behind it, and bringing more on exchange, more competition for flow means better prices. Fact. That's not a bad idea.
Yeah.
But maybe the way in which it's being proposed, and also proposed with 3 other proposals, and just so your listeners know, and if they care, a lot of the frustration with Gensler is not just these 4 proposals. There's been about 20 plus proposals on all other aspects of asset management, broker, exchange, regulation. So it's just sort of like these 4 came in like a little Christmas stocking on December 15th, and people were and they were so anticipated for a while, and they were pre-sold. Everybody knew what was coming. And then people acted like really surprised. They're like, wow, they really proposed these.
They did it.
Yeah, they actually did it.
So wrapping things up, sadly, I want to talk a little bit about how that contrasts with sort of like people in the crypto space begging Gensler for more regulations.
Yes, yeah.
People in crypto are down on their hands and knees begging for more regulations. We want an update on these 90-year-old SEC regulations that define what a security is. And they're not getting it. They're basically being told that the current regulations work just fine. And do your research to make sure that you're complying, or we're going to come get you.
Yes.
As you kind of like juxtapose those 2 regulatory positions, like what is it that you think that's different about the crypto investors and their and the SEC's seemingly reluctance to give new regulations and their desire to give so many new regulatory proposals elsewhere?
Yeah, so it's a really, really great question. What I would say in the crypto space is I believe the SEC will make some proposals. Mm-hmm. But just to give you an idea, the ones that dropped in December, I'd heard they were 6 weeks away for about 12 months, just so you know. So
literally,
I swear to God,
yeah,
no joke.
Yeah,
if you look at the SEC and what Gensler has said, he said, yes, this is security. Come on in and talk to us. They're not really saying these have to trade the same way that current securities do, because there's nothing set up for that. Like in fairness to like XRP and all these things where they're talking about regulate them, Coinbase got their Wells notice and all this type of stuff. However, I do think what you'll find is some definition of security to digital assets, crypto, but let's just call them digital assets for now, will be granted. It will be different to what we operate under, like stock right now, but it will be more in line with that. And then once that happens, and that's why you've seen it already. Like, I mean, we're building out a digital asset exchange. We're building it out on the same technology, the same rigorous system compliance and integrity, another SCI acronym of mine, that regular stock exchanges must adhere to. These things are all now done on the internet. They'll all be done on servers and data centers, probably in New Jersey.
Yep.
And it will be institutional grade technology, which will be good. And I think everybody will actually like that. But
so let's really quickly
tell us the rules. Yeah.
I love it.
Yeah.
Let's really quickly talk about that exchange.
Yeah.
Got a lot of headlines last year. We're considering partnering with FTX. I don't think it had happened yet.
Yeah.
FTX unceremoniously collapsed. A lot of the industry did some self-analysis. A lot of the industry didn't do self-analysis. What was the result of that potential partnership not happening, and where do you guys stand today? You still looking for somebody else?
Yeah, so the way we looked at it, like we had announced a partnership last like April. I guess the good thing for us is the partnership never really came to fruition because what happened, and if it turns out to be fraud, fraud is fraud. Okay, most of their company had no idea what was going on there, and that will come out in the courts. But it threw a curveball at everybody, frankly, including us. Yeah. It threw a curveball at the regulators, like we were just talking about. But I think if you actually talk to a lot of people in the industry, the people who are already trading it, they'll say, no one's turning around and going home. This thing, like blockchain is a great technology. This stuff's not going away. It's going to happen. I remember when people trading became electronic trading, and the people trading were like, that'll never happen. I'm like, okay. Have you ever seen how motor cars are built right now? The same thing's going to happen. Blockchain, crypto, digital assets will exist under our regulatory landscape, which is why we have a division of IEX called our Digital Asset Group, and we're pushing ahead. We do need the regulators to come in and tell us, how is it you want us to play at some point? Yeah. But we're pushing ahead, as are others. There's like firms like EDX out there, founded by Virtu and Citadel. They're building institutional grade. So I think what you'll see is, call it, like I can't predict this, but call it in the next 6 to 12 months, I think we'll get some real guidelines. And once you have those real guidelines, you see news that NASDAQ's building like a clearing technology. Once there's real guidelines sanctioned by the SEC that you're not going to get smacked upside the head, you're going to see real institutional players come in and create something. It won't be the same as equities. It won't be the same rules, but it'll, walk like a duck, talk like a duck, quack, whatever the hell that is.
Now, you're killing me because theoretically you gave me the perfect end to our talk right there, but I have to do a follow-up.
Okay.
So I love the fact that your initial innovation at IEX, the speed bump, was hardware. In today's day and age where so much innovation is software-based, like the fact that it was hardware that was doing this, I always thought was kind of cool.
Yeah.
You're still innovating, still exploring with new financial infrastructure. Most recently, to my knowledge, on the crypto front, through a partnership with something called the Pith Network.
Yes.
Can you just very briefly talk about, so what is the Pith Network?
Yes.
What role does that play in financial infrastructure today, and what do you think that might play in the future?
Yes. No, so we were really excited when they approached us about quoting on the Pith Network. So what Pith Network is something called a data oracle. And a data oracle basically is a source of truth, if you will. So when someone is trading a smart contract, that's what they call it in like the crypto world, right? But if the smart contract is based on the price of a U.S. equity, right? Who can best provide quotes in U.S. equities? U.S. stock exchanges. So what we do, we and other stock exchanges have since joined. We connect to the Pith
Over
Network.
60, I think.
Yeah. Oh, yeah. But like, there's actual U.S. equity stock exchanges. There's FX exchanges. There's prop trading firms, and everybody's contributing different data in different ways. For example, all the stock exchanges, what we do is Pith sends us a request, and we provide a quote, and we provide a midpoint. So if we think the price is 10 bid, 12 offer, we report to Pith 11. But we're doing it on this institutional grade technology where a lot of old data oracles, there's nothing old in crypto, a lot of legacy data oracles were using things like Google Finance and stuff. And the reason why I like Pith is, like we were talking about, crypto, digital assets is the future. It will be institutionalized, and every aspect of it should be. And Pith is the first foray into a real institutional grade data oracle. And it's been great. And by the way, it's been great for like our tech team. People are interested in the space, doing something different. And so, like, we're thrilled to be part of it, as are probably the other 59 others.
Yeah. It was such a pleasure, Ronan. Thank you so much for the time to come out and join us. Can't wait to see what you guys do next.
Absolutely.
Take
Thank
care.
you. Appreciate
Bye-bye.
it.
Thank you.